I like AI stocks over Bitcoin any day, any time of year, because there's hope on it. We have a huge build out that we're going to do over the next couple years. And I understand we can chart crime it. Brian, we can just keep putting debt to equity ratios on Oracle and keep talking like it's a bubble, right? But this is not .com. I was there during .com. I made and lost many, many fortunes during .com. And this is sort of fundamentally different. Now, is there excess? Of course there is. Are there concerns about how we're going to support all this AI infrastructure? Sure. But Bitcoin is just a price and a chart. AI is something that in a couple years we're all going to be doing. We're all doing it now. It just depends on how quickly places like Microsoft and Facebook can get us to start paying them, how OpenAI is going to start paying them. I mean, even people are paying Claude. I'm spending thousands a year now in subscriptions for various AI tools. Okay, and I don't really feel like I'm an early adapter. I feel like an old guy. So I think when you start looking into next year, the earnings are there, the momentum is there, but you're going to have to deal with the pullbacks and you're going to have to deal with very sharp, high volatility because AI just has more beta. So what you think is a 10% pullback might express itself in AI stocks 15, 20, 25, and that's going to be completely normal. But go with what earns money, not something that just sucks up electricity and has no revenue model.
It's read on my screen today, Marta. You're saying it's a welcome, you say reset here. Why is it welcome? Why is it healthy?
Well, I mean, when we think back over the course of the past several months, really since Liberation Day on forward, it's been a grind higher market with very few opportunities for a breather, and it's felt like momentum upon momentum. Of course, we see that in the market broadly. We see it in AI stocks specifically. We also saw it in areas like Bitcoin. And so I think it's well worth taking a time to just make sure that we're pricing in the full range of outcomes when it comes to AI and not just the upside. And I think that's where we were for a while.
So do you see, Marta, are you telling clients you see a correction but not some giant unwind?
Exactly.
Is that it?
Exactly. So I think what we're expecting is some sort of reset based on where these valuations have been. When we look at valuations for tech in particular, but for the broad market overall, they're in the 9th and 10th deciles. That's where they've been sitting for the past several weeks, for the past few months even. And that to us typically implies weaker prospective returns on a 3-year basis. But that doesn't mean that we think the AI trade is, a complete hoax. We think there's real value, there's real productivity gains, there's real substance to what we're seeing among AI. We don't think there is economic froth, though I know that's the market concern today. We don't necessarily think that the sentiment is full throttle, but we do think those valuations need to come down.
You don't see an AI bubble?
No.
How do you define bubble?
Well, I think there's a few characteristics. One, you do have to have the extreme valuations. You also have to have the economic froth. You have to have companies disregard the basics of fundamentals and be chasing after new business lines, loading up on debt. We are seeing the beginnings of that, but it is very early beginnings. In fact, hyperscalers, if you look at from a debt to enterprise value perspective, are still well beneath what you would expect for companies of their heft. So I think there's still room to go before we start saying that the economic levels are frothy. And I think on a sentiment basis, we've seen sentiment reset pretty markedly over the past few days. We've gone from a pretty risk-on environment to an extreme risk-off environment. That would suggest that sentiment didn't get too far ahead of itself.
I guess what gets investors more bullish though, again, Marta, like on the other side of that correction, would I have to see data that says, do I have to be assured the Fed's cutting? Do I have to be assured the economy is resilient? Like what do you think I'm looking for to make that turn?
Well, one, I think just the very fact of pricing in a fuller range of outcomes can help stave the losses that we might see. If investors feel like, hey, we're not just pricing in the upside, we know that there's going to be fits and starts along this journey, then potentially just the valuation reset alone is something that can help the markets grind higher. But I also think what we're looking for, investors generally, is continued deployment of AI. So this idea that we're bearing fruit. Now, we did see that in earnings. You see that in cloud revenue, but we're going to want to see that narrative reinforced over the course of 2026, which looks like it's going to be another capacity building year.
Well, what if next year I just saw more capacity building? What if that was the theme rather than deployment? How do you think investors would respond?
To be fair, I do think 2026 is going to be dominated by capacity build. When you look at what expectations are for demand and what the ability is to supply that demand, there's still a mismatch there, not just for 2026, but 2027. But I think we're looking for those idiosyncratic stories. You're going to want to see growth upon growth for the cloud revenue in particular. You're going to want to see those stories like Uber coming out and deploying AI. You're going to want to see those kind of checks along the way that suggest that this is beginning to bear fruit.
What about that NVIDIA report tomorrow? How important is that for the market?
I mean, it's a macro indicator at this point. It's hard for me to imagine, given the sentiment today, that we can see an upside surprise. The concern is even if they do blow it out, that investors are still going to be skittish, just because that's the sentiment in the markets today. So I think it is very critical. I'm not sure, though, even if it's a strong report, that it's necessarily going to tip the scales in favor of a market rally.
What about the Fed? What are your expectations for that meeting next month?
Yeah, so with the Fed, I mean, I tend to think the Fed has one more cut in them.
One more, that's it.
Yeah, well, when you take a look at what we saw with payrolls, I think a 50 basis point adjustment might not be enough to recalibrate the interest rate policy to account for what we're seeing on the job side. But I think the market has consistently gotten ahead of itself when it comes to rate expectations over the course of time. I think it tends to want to push the Fed to move faster, and it has continuously had to recalibrate that. We see a lot of stickiness and inflation. I mean, core PCE actually ticked up over the course of 2025. I don't think that's a green light for cut upon cut.
Yeah, and to your point, we have seen our central bankers, some of them coming out and
That's right.
clearly highlighting that. I'll get you out of here on this. Bottom line,
Yeah.
you're telling your clients the opportunities are where?
Well, I think, I tend to think the markets are pretty overvalued across the board. I mean, I think that we're really in a position where we want to continue to rebalance portfolios. I'd like to see tech valuations come down a bit more before we start to call this an opportunity. But to the idea that this is a welcome reset, if that does happen, then I think that's an area investors can add to.
Marta, always great to see you, especially on set.
Yes.
Thank you.
Yes.
Amazon and Microsoft were downgraded to neutral by a Redburn analyst. He says the bull case for generative AI is, quote, no longer clear. So let's ask a veteran tech investor if he has any qualms. With us is Paul Meeks, Freedom Capital Markets Managing Director. Paul, it's great to see you this morning. So we had that analyst come out and say, maybe generative AI is not all it's cracked up to be. The market seems to be saying that to some extent, or at least is asking questions, right, as expressed through the selling. What do you think?
I think that particular call is just chasing the market down and then coming up with a fundamental reason after the fact. I feel pretty comfortable with 2026 AI infrastructure build. I don't think that it's going to collapse in 2027. And so the folks that are supplying the picks and shovels and axes, I think they're going to do very well. And I think that tomorrow, when NVIDIA reports and gives their guide, Jensen Huang, as he always does, is going to make us feel good about NVIDIA's prospects and the rest of the industry. And I think we'll probably get some kind of a relief rally in some of these names because they have imploded, as you said, not since October, but even in the last week or two. And so I think it's going to shape up for a better buying opportunity. I don't know when the correction ends. Nobody knows that. I've gone from being a fundamental analyst to a technical analyst. But when some of my favorite AI infrastructure stocks settle on low volume and the selling looks exhausted, I'm going to buy them with both hands.
Paul, at the same time, I was looking through some of the commentary in the Bank of America monthly fund manager survey. And one of their findings is that it's the first time in 20 years that investors say companies are over-investing, right? So even if you believe in the infrastructure play that spending will continue, at what point has it gone too far? And at what point has it maybe extended to the further reaches of the universe, if you will, and maybe that there are some players that have become overextended?
There's always that situation, right? You could never shotgun shoot these things. You have to be more targeted with rifle shots. But I don't think that the spending is going to be curtailed for quite a while. Now, at the end of the day, do we have to monetize, not in a little way, but in a big way, some of these apps? Of course. But I don't expect to even have to make that call for longer than my investment horizon for some of these stocks to double quickly off their bottoms.
So what are your candidates for stocks that might be doubling quickly off their bottoms here, Paul?
I think CoreWeave and Nebius, which are two neo clouds. CoreWeave, for example, last week announces results. Their guide is 3% lower for revenue for 25. And since then, their stock's down about 30%. So I think that's a gross overreaction. And so the neo clouds and some of the neo cloud adjacents look interesting to me. And even mighty NVIDIA, I think it actually is now trading well under 30 times, actually a PE ratio, not that much higher for next year's earnings than the S&P 500. And I think we're going to do great there. It's just an overreaction. And of course, the sell side analysts typically, when stocks are falling, nobody has the courage to step up and go contrarian. I'm doing that today.
And in terms of NVIDIA, right, even when it has come out in recent quarters and beat, and it has mostly beat, the stock has frequently fallen. Do you think that
Right.
it's at risk of doing that again? Or do you think because we've been selling off in advance of the report, it's sort of better positioned this round?
I think it's better positioned this round, but who knows what happens. We also have a bit of an obstacle that now it doesn't look like a slam dunk on December 10th that the Fed is going to lower rates, which we really need to propel these aggressive growth in other tech stocks. But I think NVIDIA has come down so sharply with all this commentary and lack of support of that company and others by the street that I would expect a relief rally the day after tomorrow.
Paul, there's some breaking news that I want to ask you about on this subject of NVIDIA. And we've got yet another partnership, but this one doesn't involve OpenAI. It actually involves Anthropic. So NVIDIA is going to invest $10 billion in Anthropic. Microsoft is going to invest up to $5 billion in Anthropic. And Anthropic, in turn, is committing to buy $30 billion worth of compute capacity, Azure compute capacity from Microsoft. Now, we've seen these deals usually with OpenAI at the center, but it seems like everybody's got a deal right now. Is it just like sort of, this does not feel like a rifle approach when it comes to these companies investing each other. It does feel like flooding the zone, to mix my metaphors. What do you make of this latest one?
Well, I think it's an incremental positive, and at least we're getting away somewhat from the codependency on OpenAI. But there is no doubt we have a very intricate web of interrelationships between these companies, because you think about Anthropic in particular, one of its biggest shareholders is Amazon.
Right.
And now they're doing deals with Microsoft Azure. You'll expect this to continue, but I will tell you this, I feel pretty good about the spending for the next couple of years because 90% of it is coming from the hyperscalers who have the finances to do it easily. And B, all of the CEOs of these big spenders are seeing this as early and heavy spending on AI infrastructure as critical to their competitive advantage. And when you get guys like Mark Zuckerberg saying this, the most ruthless guy on the planet Earth, I believe they're going to spend the dough.
I love that characterization of Mark Zuckerberg. Paul, finally, I want to ask you, we're going to talk to Wall Street Journal columnist Greg Ip in the next hour. And he was out with a column today where he said, if you're in the market right now and you've been investing in these names, you're doing great, even with the sell-off recently. But the sentiment around AI is pretty lousy from normal people. They're scared it's going to take away their jobs. There's a lot of uncertainty. And that past cycles haven't necessarily been like this in terms of the trepidation around this innovation. Is that going to be a curb on it ultimately?
I don't know if it'll be a curb on it, but as far as the anxiety that is impacting the common guy, yeah, I think that continues. But what will happen is with most technology transitions over the history of time, what happens is, yes, some people lose their jobs, some people find jobs, but overall, people become wealthier. And when they become wealthier, they spend more. So at least indirectly, that propels the economy.
My next guest says the specter of a steeper decline may be overdone, and the bubble talk itself may be facing a bubble. Joining us now, Nancy Tengler, Laffer Tengler Investments CIO and CEO. Nancy, it's great to see you. You know, it's really funny, all of this bubble talk, because as I was saying earlier in the show, the vast majority of folks we are talking to are saying it's not a bubble. They say things are, you know, some things may be richly valued, but they don't consider it to be a bubble. Nonetheless, something was causing the sell-off last week. So what do you think is going on here sentiment-wise?
Well, it's great to be with you, Julie. I think a couple of things. I mean, I may be a little bit cynical, but I think a lot of the narrative has been driven by people who got out during the tariff tantrum and forgot to get back in. And then, of course, valuations have run dramatically since then. But I was managing money in the 1990s, and it didn't look at all like this. You've got CapEx spending that's just getting started. It was escalating or skyrocketing during the entire decade of the 1990s. You got earnings growth, and the growth stocks are expanding at 20%. In the 90s, and from 96 to 2000, it was contracting. The best performing stocks in that decade were companies with no earnings. And that is just not the case now. And so will there be an overbuild? Maybe, but it doesn't look like it yet. And it doesn't look like it for the foreseeable future.
Nancy, something that has really struck me about this innovation wave, this huge rally that we've seen in the markets, is how ambivalent normal people seem to feel about it. And when I say that, what I mean is, if you look at survey data about AI, people are not super excited about what they think is a potential for them to lose their jobs. And that has happened to some extent in past innovation waves. But this one feels, the sort of disconnect feels a little more dramatic. I don't know. How do you think about that?
Well, you could be right, Julie. And I think it's been exacerbated by the fact that we don't have any data. So consumer sentiment numbers are pretty moribund, but I will say that we think the One Big Beautiful Bill Act is going to contribute to consumer spending due to, the bill was retroactive, as you know, and the payroll taxes were not adjusted. So there will be big refunds. Some are arguing 150 to 200 billion, and that money will get spent because it's going to the lower income cohort who usually does spend. So we've actually been adding to consumer discretionary in here, and we expect that the sentiment will shift upward, and that may bridge the gap to the disconnect you're talking about, because unemployment is still at super low levels. We are seeing layoffs, but we're not seeing the kind of layoffs we've seen in periods of recession, pre-recession, or a really weak jobs environment. So I think stay tuned. I think a lot of this has been exacerbated by the vacuum of information.
Well, and to that point, of course, we're going to get a jobs report, but it's going to be for September later this week. So once we start to get more of the more current numbers, do you think things are just not going to look as bad as perhaps the sentiment would indicate?
I think so. I think they're going to look not great, but they're not going to look horrible. We have some clues from the ADP weekly numbers now, the Revelio numbers, the ISM, which is privately, constructed data, gives us some insight into manufacturing and services employment. And we're also seeing that, generally speaking, consumers are still spending. It's mostly the upper income cohort, but people are working. And so once we settle in, we expect to see some wage growth next year. That will help. The tax refunds will help the consumer pretty significantly. So I think, and the jobs numbers have been so dramatically revised, Julie, to the tune of 1.7 million over the last 2 years. That means productivity is actually better than has been reported. So we're pretty optimistic. I think that will turn. And once everyone gets an optimist in every home, I think you'll see a lot of enthusiasm around AI.
Well, that's still feels like we're a little bit far away from getting an optimist in every home. But, be that as it may, you are still definitely buying and holding at least the AI trade here. And I think it's notable that I know you still have NVIDIA. We've talked a lot about that. I know you still have Broadcom. And I find it notable that it is the big established names. It doesn't seem like you're going that far out the sort of speculative spectrum when it comes to AI.
Well, we're not in our major large cap strategies. We did launch a strategy that is a thematic strategy at the end of the last quarter, and it focuses on quantum space, robotics, and nuclear. So we do have some of the speculative names in there, but effectively, we think that you want to own the leaders in this environment, the fortress balance sheets, the companies that can issue debt attractively. You saw the Amazon news today. That's in our 12 best ideas portfolio, 5 for 25. But we also have broadened out, and that has been our theme for the last 3 years. Old economy companies that are embracing the new technologies. Think Walmart, think Raytheon, for example, as poster children for that side of the theme, and then the suppliers of the picks and shovels.
And you mentioned the Amazon debt sale, which Bloomberg is reporting this morning. When it comes to not necessarily the Amazons and NVIDIAs of the world, if they're taking on debt, but do you have any concerns about companies that have more debt on their balance sheet that are more speculative? Oracle, for example, which is now junk status according to the ratings agencies. Do you have any concerns on those fronts?
We do. I mean, I think at the center of our concerns are the commitments for CapEx that OpenAI has made. And the worry is that they won't be able to supply the revenues or raise enough capital to cover it. We had a call with Oracle last week. They are committed to keeping their investment grade rating. And so I think you will start to hear more from the company. I'm not convinced that sell-off was justified. The stock had certainly got ahead of itself. It's a member of our TGLR portfolio, which is our ETF, and it was the largest holding. We trimmed it back in the low 300s, but we still own a good chunk of it. And I think they became the dumping ground for the concerns post-Meta earnings and then this overcommitment, in my view, by OpenAI. So we will see. We may be adding to that name here in a little bit because it has been. It's just become a narrative stock, and the fundamentals are still pretty darn good.
Data center boom is reshaping America's economic map, and much of that growth is happening far from Silicon Valley. Our next guest calls it the rise of the, quote, rodeo region, a stretch of the Mountain West and the Southwest now attracting billions in investments from tech giants. For more, we want to bring in here Rick Peterson, Bow River Capital Vice Chairman, Economist, and Chief Strategy Officer. Rick, it is good to see you. So you refer to the rodeo region of the country that you say is America's new data center heartland. Why, Rick? Let's just start right there. What explains that trend?
Well, a number of reasons, Josh. The center of the country where our company invests in alternative assets, be they private equity, real estate, software, private credit, we have found this part of the country for the last 15 years growing at a pace faster than the rest of the nation, measured by employment growth, income growth, labor participation, job creation, and productivity, almost all segments. And so that underlying that is a part of the reason why we're seeing the sort of the attraction to the middle of the country for these mega projects. We're watching, obviously, this capital investment in semiconductor plants and in data centers for three important reasons. One, this is a important component of overall U.S. economic growth right now. Number two is these investments drive the regional economies where the facilities land. And like everyone, including the stock market, we're trying to guess at when these investments will create returns for the companies and also for the United States in terms of productivity. The important reasons, I think, Josh, that we're seeing semiconductor plants in, for example, Arizona, data centers largely in Texas, has to do with land availability, cluster of operating synergies, but very importantly to especially data centers is the availability and cost of electricity to drive them. We have that in the center of the country, Texas particularly.
Let's take a real-world example here, Rick. Google just committed $40 billion to the great state of Texas. So how should we think about what that could potentially mean for the economy of Texas in terms of ripple effects, Rick? I mean, how do we think about what that could mean for jobs, for tax revenues, for environmental impact? How do you try to think about it?
Well, first of all, Google chose that part of Texas specifically for the same reasons that Oracle, OpenAI have chosen that part of the country. West, North Texas has more power transmission and generation than it does demand. And so these companies are anxious to locate where they can build and build quickly. Another reason is the grid operator in Texas is the only major grid operator in the United States that is not regulated by FERC. And so faster permitting, simpler rules, frankly. But what happens when Google decides to move into an area like Abilene, Texas, Amarillo, Texas? It has significant knock-on effects to the regional economy. Not only do you get huge investment in facilities as measured by construction employment, you also get permanent employment, operating jobs, which creates secondary and tertiary jobs. For example, you will see at Google, once those plants are open, a series of indirect jobs, everything from cloud service providers to cybersecurity, specialized suppliers of water, et cetera. That is the first order of magnitude, and then from there you get second order, housing, retail, schools, et cetera. For every data center employee that is permanent at a site, we think there are 4 to 5 indirect and tertiary. Semiconductors even more, 6 to 7 times. So it creates a significant ripple effect in the economy in terms of more jobs and also investment. Something that isn't understood is these companies, Google, OpenAI, TSMC in Arizona, once they're there, they invest in workforce training, they invest in the local infrastructure. You see everything from roads to water to schools being advantaged because these companies make these decisions in these locations.
Rick, I only have about 60 seconds left, but very quickly, this AI data center build out, Rick, it's become political. I don't know if you saw this. The Journal recently had a piece about how the political left, for example, they're pointing out downsides of the AI data center build out theme. For example, its impact on electricity costs, Rick. I'm just curious how you think about that.
It's a good question, and data centers are indeed being blamed for electric costs rising. No doubt they're a part of that. I think in the last 12 months, the state of New Jersey had the highest rate of increase of electricity costs. But data centers are only indirectly responsible for that. A lot of that has to do with the grid, the surrounding demand, et cetera. And so, frankly, this is another reason why you go to a Texas or an Arizona is the generation, and it's not just natural gas anymore. It's wind and solar. Texas leads the nation in both of those sources. And so I would say, notwithstanding electric rates coming up, frankly, the blame is more prosaic. It really isn't data center driven directly. Indirectly, it is. Much of it has to do with the state of the grid, which is now in many states 60 years old and needs to be rebuilt. They're having a hard time doing that in the Northeast.